This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Corey Wright.
Hey, and I'm Adam Scalina, your sometimes host. Corey,
Yes,
man,
sir.
you look like $1 million. You're,
I feel like about 300 to be honest with you.
Really? Well,
About $300, not $1 million. $300.
You're in a three-piece suit. I'm in a garbage bag.
Well, I knew I hadn't seen you in a while, right? So that's why I put on the nice duds.
You
today
put
for
on Givenchy, I put on Garbage. Yeah, this is how
H&M.
this is the relationship. Anyways, we've got a fantastic show today.
We do. Lots of people had reached out to us, said, what's going on with these interest rates?
Right.
So anytime it comes to mortgages, interest rates, anything like that, we go to the source. Al over at Impact Commercial joins us today to talk about what happened earlier this month, what happened these past couple of days down south,
Right.
what's going to happen next month with the Fed meeting and the BOC. So he's going to kind of unpack all that stuff to give us some guidance here of where are we going and when does it stop?
Right.
When does this stop?
Well,
So-
yeah, this is coming on the heels of yesterday's announcement of a 0.75 increase coming out of the U.S. Man, I feel like the tone, at least in the residential market, has kind of shifted since yesterday. I feel like people are kind of pulling back and wondering what's going to happen. We were just talking, it sounds like you're really busy right now in commercial.
We are extremely busy right now, but again, it's asset focused and it's
Right.
market focused. And in commercial, the lending, which we had Pete Leung on last week, talks all about the different requirements to buy commercial versus buying a house. A house, they care who Adam is and how much Adam makes. Commercial, they don't really care who you are. They're like, hey, how much does Starbucks pay you?
Right.
Right. So you have different lending criteria. You're not stress test like you are in that. So different requirements and different assets. Some assets are up, some assets are down. So things kind of keep going there. And I think also you have big institutionals and REITs and all these type of guys that will come in with cash to buy large scale assets. And those things got to move. And right now there's potentially arguably some discounts in the marketplace with guys that have to move product.
And that's not money that sits on the sidelines.
No, because even during this inflation, that money's devaluing itself on a daily basis sitting in an account. So they've got to get it placed. And you got funds that have money that have to get placed. So on that aspect, things are still moving. But again, it's specific products moving. Things that isn't as desirable, that's really, really expensive, not worth what it is.
Yep.
It just sits. So
interesting. So I'm actually really curious. We haven't talked to Al yet today, but I want to know, first of all, of course, what his thoughts are about what's going to happen with interest rates and how long we're going to be in this situation. But also, what is the strategy right now if you're going to get financing? Like, how do you set it up and how is he setting up deals right now?
Yeah, well, I think, we talked a little bit on the show about loan to value and how that dramatically is impacted. And that's pretty much your down payment versus your loan for the listeners. So guys that are buying stuff have to have much more capital available to them to buy the same asset. And when we talked about multifamily, which probably had the lowest cap rate, going back to the peak of the COVID market, you were probably seeing things done like mid twos. Those same things are now probably, say, at mid threes on the cap rate side, but are still probably 50, 60% loan to value. So you're still putting down 50 or 40, 60% to get the deals done.
Right.
So although sometimes CHMC can give you 10-year amortizations and there's ways to get creative with it, it's still a lot more money out of pocket to do it. And when you look at the multifamily asset class, which doesn't have triple net rents attached to it, you've got garbage is going up, water is going up, insurance is going up, property taxes. So that really hits home when you're doing in a gross rent type of situation, that all that compounded there. That's an asset class that's definitely slowed down versus an industrial.
Is that safe to say that's the market that's getting hammered right
100%.
now?
So the multifamily market's probably taken the biggest brunt so far.
Right.
Probably shortly followed by development land. Because development land, typically there's not a lot of money to debt service. So you're putting down a gigantic amount to make it happen.
Sure.
Office is hit or miss depending on the market. Retail seems like it's been doing fairly steady, and industrial's obviously leading the pack still. But leading the pack still now is slower than leading the pack this time last year.
So people looking to time in those specific industries, is now the time, or do you think that there's a wait period here?
If you have funds available to you,
Yes.
and you can put down the 50 or 60% in some situations to do it, you might get stuff at a discount. And to make the numbers really jive properly, sometimes you pay a little bit less for a product, but you pay more in interest and the numbers don't really balance. So, but if you've got the available funds to you and you can go in there and you can get a large down payment on a property, which is going to reduce the interest you're going to pay on the mortgage that you're taking out, you pencil it out, say for a year or 2 years, interest rates come off, you refi at that time, you get back into those low interest rates, you lock in for 5, and you pencil out 5 to 10 years on the asset. You could argue it's a pretty good time to get into the marketplace if you have the additional capital available to you.
Right. You heard it here first. Without further ado, why don't we cut to our conversation with Al?
Enjoy, guys. This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes to under the commercial umbrella. You're building a building in development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion.
Okay, so we're here with Alan Haigh. He is the managing partner at Impact Commercial. How you doing, Al?
I am doing beautiful, guys. Look at the weather outside. Can't complain with late September sunshine.
It seems it's almost eerie how warm it is. It's beautiful for this time of year.
Well, I feel like we're making it up considering we had that crappy spring. So it's
Right.
That's what we're looking for.
So Al, for our listeners, that a lot of our listeners know who you are, but can you tell our listeners a little bit about yourself?
Oh, a little bit about myself. Well, managing partner of Impact Commercial, love playing hockey, got 3 kids, work with you guys all the time. And you know what? We're just looking at Impact to help our clients out. Consider ourselves a little niche commercial mortgage shop that helps people with their debt solutions.
So Al, we are a podcast of the people.
Yes.
And our good friends at the BOC last month decided they're going to raise rates. Our friends down south yesterday thought, okay, let's do this again. High probability it's going to happen again in October. The people have reached out and they've said, what is going on with interest rates? Where is Impact Commercial on the podcast? So because we're a podcast of the people, we called you. We got to bring you on and we need to find out what is going on and when does this end?
Yeah, all right. Well, I'm going to give you guys some sort of on the street sort of knowledge. I am for sure not an economist. You can bring up I think it's Doug Porter. You can bring up all these other guys that they'll sort of go through the numbers of everything. What we kind of like to think of ourselves here is just we take all these little data points, right? And we take all this sort of these market movements, and we like to sort of think that we are a little bit, we're in the market as the market happens. We're not looking back, 30 days and 60 days with data. We're in the data right now. And so it's a great question. Where are these interest rates going to go? What I can tell you is, man, oh man, I remember earlier on this year where a 5-year fixed rate mortgage, we were doing 3%. And it's September, and we're getting quotes easily in the 6 to 7% interest rate for the same mortgage. So it's just been a sea change. The unpredictability and the speed at which interest rates have increased has just been unbelievable, guys. And I think you're starting to see that, on the real estate side of things, like from the realtor's perspective. So I just want to sort of start with that. Like that's what we are seeing. Maybe you guys can tell me a little bit, like before I kind of drone on into more of the, the specific interest rate stuff, but what are you guys seeing, on the real estate side?
Well, I think Adam hasn't seen anything for a while. So.
Oh, sorry. I'm coming live from. I'm in Miami right now. Al. I'm on forced retirement. No, I think residential has softened quite a bit. Absolutely, and affordability. But what I would say is actually, I've a few of my listings sold in the past 2 weeks, and I would say that the buyers that are out are very, very serious. So you're not getting 30, 40 people through an open house, but you're getting 3 to 5 and they're all ready to purchase.
And we're seeing this, obviously the loan to value have changed dramatically, and maybe you can touch a little bit about that from a refresher for our listeners. But loan to values have changed dramatically on the commercial side, where guys are having to put a lot more cash and equity into the properties. But at the same point in time, where it's market specific, it's asset specific, good product is still selling, and we still have a lack of inventory across the board. So,
and that's what's happening. Residential, the inventory is still very low, and the tier 1 properties are still moving.
We're seeing the same thing.
But Al, are you like, so is your volume down in terms of how many people are reaching out, or how many deals you're processing?
You know what I would say is no, the volume is not down, but like Corey was mentioning, is like the what we're doing is changing. We're still doing a lot of multifamily, we're still doing a lot of industrial, because those are the two, probably strongest of asset classes. What we're not necessarily doing is construction, right? Like it's just like construction is one of my specialties where I do, a lot of it. But when you look at, interest rates, like the cost of financing, the construction of a property has tripled effectively in the last year. Tough to build that into pro formas when you're trying to be a developer to do their stuff. Everybody's seen inflation and supply chain issues, and you see the increases in the hard costs of doing any kind of construction. Whether it's a single family home, whether it is a large condo building, right? They are up 15 to 20% in a very short period of time. And it's tough to, for a lot of the developers out there to actually go, okay, yeah, it's feasible to enter into a 5-year project from start to finish with such unpredictability with financing costs, hard costs, and things like that. So, the construction side of things has really taken it on the chin. And you can see that with a lot of the projects sort of, stalling right now or being pushed off to next year. And construction has certainly slowed. The investment property purchases, like again in the past, like I'm going to reference, a caller that was from years past, and we've done a couple of deals with them. And, we were able to do a nice little industrial purchase up in Kelowna. When interest rates were 3%, and we got 75% leverage with it. Nowadays, that purchase is, we'd be lucky to get 45% leverage on that. So people are just having to put a lot more down on those investment purchases, and it just, people are just taking a pause on that one. There, it's like, do you want to tie up that much equity into the property at that time? So we are seeing investment sales, sort of slow down.
Now, Al, can you talk a little bit about that on the loan to value aspect for the listeners there? So if I'm buying a property, let's say hypothetically, we'll make numbers real easy. We'll say it's a $10 million property, which is probably more like Adam buying it, not me. But let's say it's a $10 million. Yeah, Adam owns real estate in Kelowna, so he's loaded.
Okay.
So let's say I'm buying a $10 million property and it's got a 5 cap rate attached to it. And my interest rate's 3%. And let's take that same scenario and say my interest rate is 6%. How does my down payment change in that scenario?
Okay. So what we end up doing with this is that you have different variables within the, sort of the calculation of what kind of mortgage amount you can get on a property. Now, one big difference between commercial real estate and residential real estate is that on commercial real estate is that it's the income of the property that, provides support for the mortgage payments. Okay. And so when you're at that $10 million purchase is like at a 5 cap, that would end up being a $500,000 income for that property. And so that $500,000 income can support, mortgage payments of annual basis of like $400,000 worth of mortgage payments. The issue is that when you're buying it at 5 cap and your interest rate is 3, you have a 2% spread, right? So your yield is that much higher than your borrowing rate, and that allows you to have a higher loan to value because your amount of your income going to interest and principal payments is a lot lower. If you invert that and you go from an interest rate of 3% to an interest rate of 6%, and your cap rate is 5%. You have that inversion, which is always at an issue. That just means that all things being equal is the mortgage amount that you qualify will be less because more of that income that you have goes to support the mortgage payment. That's just the crux of where it is. So in the past, at 3% interest rate, we could do a 75% leverage. Now we're lucky to get to the 45%, 50% leverage. And that's what's causing the slowdown and all that stuff.
So essentially, is my down payment is growing from potentially 25% down on a 75% loan to value to 50 or even 60% down to buy that same asset if my loan to value falls to 50 or 40%.
That is correct. And so that's why you see a little bit of a slowdown in that aspect there. But that is just one element of like the investment decision for, say, commercial real estate. And one of these things, and you guys will rightly, is that like, listen, like we're a collector of data points. So obviously one of these data points is how much equity that you have to put down. Another kind of data point that we always have to talk about is, what's the best type of asset that does well in an inflationary market? And it's, largely it's economics, man. They aren't making any more dirt. They're not making any more land, generally speaking. And so commercial real estate, even if you've got to put more down on it, is that it is still one of the best options as a hedge against, higher inflation. So, our most successful clients, they are strategically still buying, good properties. Even if they got to put more down, that's just okay because they know that they're going to come out of it much better off, in the 10, 20 years if you've got that timeline for your investment profile. And pretty much all of our, clients, if you're investing in commercial real estate, that is the sort of the minimum, expectation is what is our 10, 20 year, time horizon. So that's what we're seeing is, you got the countering of the, increase in interest rates by just understanding the strength, the absolute strength of what commercial real estate offers for an investment portfolio.
The rate increase, has it changed how you're structuring deals or the advice that you're giving potential purchasers?
100%. So what we are seeing is a lot more alternative financing. And so alternative financing is not, it's not that, historical sort of B connotation on the negative side. Is alternative financing is usually just smart lenders. They're not your Schedule I banks that have to all that regulatory requirement. They're just smart capital groups that realize, the property is a great property. The income is going to get adjusted. These higher interest rates are only going to be temporary. And so they'll lend out a little bit more on, what is the equity of the property? What is the covenant of the borrower? Like, who are they dealing with? And we are able to get some, relatively attractive, still, they're not cheap, but they're attractive, financing options that can get us 1-2 years worth of what we would call that bridge financing. So we're still doing a lot of those things there. There's a lot more opportunities coming up. We are recommending all of our clients go into either, a shorter term variable, a 1 or a 2 year maximum term. And that is because, like, with these interest rates increasing, is that we are seeing, some cracks. Demand is starting to go down. Some of these bigger banks are now forecasting a decrease in the policy rate mid-2023. And if there's a decrease in the policy rate there, we're going to start seeing that interest rates may drop next year. So if we are under the understanding that interest rates may drop next year, is like, why go long? Why go into a 5-year commitment at 6 or 7% when, you just pay a little higher right now, get that variable, and then lock in next year at hopefully something that, maybe starts with a 4%.
So now, Al, are the banks changing any of their lending requirements heading into this as rates are rising at the way they are and inflation is? Have the banks changed any of their criteria that now people are having to meet? So, as a safety net for the bank?
Absolutely. Now, and it's not just the banks, guys. Like, the regulatory environment, which, is designed to protect the system, is designed to protect the consumer, has really, amped up over the last little bit. And so, it's the regulators are coming into it and they're saying, hey, guys, it's like, you need to start stress testing your portfolio. So, if your interest rates are 6% right now, well, what happens in the worst case scenario if the interest rates go up to 9% or 10%? Like, how are you going to handle that? So what they are doing is, like, they are now taking a peek at, when you are looking at your mortgage, is like they're looking at your mortgage with the current rate right now, but they're also factoring in the theoretical possibility of higher interest rates and what that will do with to your payments. So that is seeing some lower leverage that happens on your properties because they're just like they're just not they have to plan for their downside. Again, they have their focus with their regulators is to ensure that no systemic risk gets into, the economy. And banks are like, they are systemically important. So we completely understand it. It puts a little bit of a pinch on, our borrowers, but that is just, that's part of the business. So we accept that. We understand it. We talk to our clients, work them through that. And at this stage here, it just really means you just got to put more equity into it. And that's what the Bank of Canada wants. They are tightening the interest rates to temper demand, temper inflation, so we don't have the other risk, which is we have all these bubbles that start forming in assets, and nobody wants a bubble to burst. So that's exactly why they're hitting inflation so hard with higher interest rates.
So I'm going to ask you to grab your impact commercial crystal ball here that you use. We saw a 75 basis point hike by the BOC last month. We saw our neighbors to the south. They repeated that with another 75 basis points down south. We have a meeting coming up October 26th. What is the anticipation of that meeting if regards to rates, hold? Do they increase? How much do they increase? And assuming they do, is that the last one before they review and hold, or are we looking at more rate increases next year? What are your thoughts on that?
My thoughts are, I think we're going to have another 50 basis point increase at the next meeting. The Fed came out again yesterday, as you were mentioning, with 75 basis points. Their tone is incredibly hawkish. I will admit, I personally thought that we would see inflation cool down a little bit more so than what we've seen so far. I think that, if they were to only do 25 basis points this next one here, is that they might look like that as an under. And so I guess my calls are, is I think it's going to be the next meeting, it's going to be 50 basis points. The meeting after that, 25 basis points. And then I think we're going to be in a little bit of a holding pattern. So in total, I think we've got 75 basis points, maybe 1% further increase in interest rates. And that is, that is before what we think could be, the start of a recession next year. And you know what, when we're looking at it on our side, it's like we do see, and there's so much noise out there, but at the end of the day, it's like we do look at the yield curve. And for those of you who are sort of new to yield curves, it's really a ratio between a 2-year bond rate and a 10-year bond rate, and taking the difference. And so a normal yield curve is positively sloped, where a 2-year rate is at X, and a 10-year rate, should all things being equal, should be higher, right? Like it's a steeper, steep curve. Right now we have short-term rates high and long-term rates low, which is a leading, indicator of a recession. And so, the smart money is always on the bond market. The bond market is, trillions upon trillions of dollars, and they are predicting, economic growth, much lower in years 3 to 10 than it is 1 to 2. So, where we're kind of coming into it is there's going to be this increase. Likely the policy rates are going to go too high. Demand is going to start to erode, and we'll be in a recession, which would, all things being equal, force a reduction in your interest rates, mid part of next year.
Okay, so the prediction then, just to be clear, is by middle of next year, there's a strong possibility that rates are coming down.
Yes.
And prior to that, all landlords may or may not be able to collect their rent.
Well, to be honest with you, is that there is no delinquency rates, rates of any concern out there. Tenants are always paying their rent because there's nowhere else for them to go. What it is that the tenants just have much higher borrowing costs, and when their mortgages come up for renewal, that's when they're going to get hit. So, as you're seeing on the residential side, you're seeing interest rates a little bit more pronounced there, because interest rates you could get 1.5% 3 years ago. Now it's 5%. So, those anybody coming up with renewals is in a little bit of a hard slog for that, because interest rates have gone up. Like I myself, I've just signed off a commitment letter for 5.9% on one of my things. And it's, I thought that was actually a great deal. It's for 1 year, and it looks very promising. But others are going to be a little bit less fortunate, and that's just, you just have to have cash flow and financial robustness that you can deal with these higher interest rates, albeit on a temporary basis, because I think things will work their way out of the system next year.
So Al, I don't want to put you on the spot, but we also like to talk to you because you're a real estate investor and a commercial real estate investor. Do you have an area you're really excited about, or what are you kind of looking at right now as an opportunity?
Well, I think again, I don't have the resources of you guys. So and I've got my little thing, and what we end up trying to do is we've always focused on two different areas for us to expand on, and one is the interior of BC, and we're very positive from Penticton to Kelowna to Vernon, like. It's amazing every time I go up there, which is usually once a month, once every 6 weeks, and it's just like the vibrancy, the educational system there, like UBC Okanagan opening up, the hospital expansion, like it is really becoming self-sufficient. There's gone are the days that Kelowna is a boom bust type of town. Gone are the days that it was heavily dependent on Alberta oil money going into it. It is. I look at it. It's got 20 years of runway, and it's a great place. The other place that I look at is, the eastern Fraser Valley. So, I love the Langley, love the Abbotsford, love the Mission, areas there. And the reality of it is people, in Canada, they still want their house with the white picket fence. Out there, it's much more realistic. Industry like businesses, they want, they need like say 40,000 square feet of a warehouse. Like, you can't get that in Vancouver. You can't get it in Burnaby, right? You get it out there in the Fraser Valley. So more businesses are relocating up there. More families, it's more affordable out there. So we just like some of those trends that, it just sort of all the data points come together and it just says, hey, man, you got a great life, more vibrant industry out there to support employees. Like it's like those are the two areas. But those are just my areas that I focus on. Other areas that we really love are just like the Capital Regional District down in in Victoria. Like it's fantastic. Colwood, Langford, they're all exploding. Other areas like Kamloops has seen a nice boost. So we're very lucky in BC that we have multiple markets that are actually really really good. So it's again, my stuff is we just pick two, and that's where we want to be.
So I'd be curious to expand on that because obviously from a mortgage broker side of things, you guys are seeing deals coming from brokers, private clients, and that probably all over the province. Have you seen an uptick in any particular area, let's say over the past 3 or 4 months as interest rates rise? Have you seen more deals come across your desk for financing, say in Victoria versus what you would have seen prior to these major increases in interest rates?
To be honest with you, not really. Everything has been hopping. I would say our three busiest areas are the Lower Mainland, Kelowna, and Victoria, the Capital Regional District. All of them have exerted strength. So I can't really say that any one of them has sort of exceeded past levels or under exceeded past levels. Everybody is pretty much chugging along. I would say, I think more people are increasing to look at other areas outside of, Vancouver and the Lower Mainland. More people are asking me, hey, what about Kelowna? What about Kamloops? What about Victoria? Like there's just more of those, more people asking and inquiring on, I would say, outside of the Lower Mainland. So which is good.
So what's next? So we have interest rates that are rising. The deal flow is still there. It is pocket market driven, quality over quantity on things. Where are we sitting Q1 of next year? Has that demand, based on what you guys have seen, dry up and everyone's sitting there twiddling their thumbs waiting for this to end? Or do we continue to kind of chug along, maybe a little bit of a slower pace, and again, more quality over quantity type transactions?
Yeah, I think you're exactly right. I think it's going to be a slower pace for the next sort of 3-4 months. I think February, March is where things are going to start to be. I think we're going to start to see some deal flow more so in February, March. And the reason being is like right now, a lot of people are in a wait and see approach here, just trying to push everything down a month, push everything 2 months, see where it goes. No, the desire to buy unless has waned a little bit. We also know it's like one of those aspects is like there's a lot of people have speculated on land in the Lower Mainland, and it's these times of the market that the land speculators kind of get pinched, right? Like if you're not earning anything from the land, and your mortgage comes up, and land financing isn't as easy, those people are going to have to liquidate, willingly or unwillingly, they're going to have to liquidate. And we sort of feel like there's this, pressure building up, and it won't be until after, January. But you know what? A lot of stuff happens in February now. The spring starts in February, and I think there's going to be more deals. And as soon as somebody, reprices something on the land side, because the land starts everything. As soon as the repricing happens on the land, you're going to start seeing a lot more deals come on board. And I see, a lot of the larger institutions, especially the developers, starting to look at more closely some of the, the land deals and those 5 year long investment, coming up next year. I know certainly I'm looking at that stuff, waiting for February just to see where it ends up being. Now, I could be wrong, with all this stuff here. So this is just one guy's opinion of trying to put the data points together, trying to support their clients, trying to support my clients and give them, educated advice or, just trying to add value. And so this is just one guy's. I'm not an economist, but we do try to, be more than just a regular brokerage. Is we try to give some additional information, some advice, some recommendations. So, we have to at least have an opinion, and, this is what you guys are getting.
So Al, while you still have your impact commercial crystal ball out, what will be the most resilient asset class, do you think, moving forward?
It's, I think it's always, again, nothing has come across, my desk or my computer, which shakes the whole beds and sheds. Those are like, two of the most robust, high demand, lots of money chasing, assets. We have immigration and, honestly is, municipalities and governments, on the senior level, which have not done well at, increasing the number of units being built. So, all the big money in Toronto, all the big REITs, they know that, multifamily rental in BC is one of the strongest, most robust things there. So that's not going down. And the same thing with industrial. It's so pinched right now that, we're unfortunately losing. BC is losing to Alberta because they have massive tracts of industrial, property. We have nothing. And so those are the most robust things that I really look for. And I think is the next robust for clients and people who are looking for opportunities is, if you can get something that's just well located. Like we've always had a hankering, and I've seen some clients do really well with buying, covered land plays. Like, you're buying an older strip mall that's on, 3/4 of an acre at the intersection, of two streets that, in 5-10 years, could be, a 6-story, rental building or 6-story apartment building. So we sort of see those types of, properties as probably being the next on there. And those are probably the ones the 3 that I would really like to highlight.
Sound advice for sure. We do have this segment called the 6-pack. Can you stick around for that?
Absolutely.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Corey.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca. All right, Al, we'll give you an easy one. We're going to change this up a little bit because I know you've been a repeat guest here. So we're going to have to change this up a little bit. So we're going to go favorite bar and restaurant. We're going to go Kelowna style on you in this one because I know you're always up there. I always see every time I talk to you, it seems like you're sitting up there poolside having a drink, buying another property. Favorite bar or restaurant, Kelowna edition. Where are you going?
You know what? What's that one that's right on? Is it Oak and Barrel?
Is this the one at the Grand Hotel? The big beautiful. That's where Adam stays. That is, I think it's called the Oak and Barrel or the Barrel and Oak. I know which one it is because every time I go up there and Adam's staying there and I drive down from the Marriott, that's where I meet him for lunch.
Yeah, they put me up while I'm cleaning the bathrooms. This is.
Sorry, Oak and Crew. Oak and Crew.
Oak and Crew.
Okay, so you know what? It's tough to beat that patio. The other one that we had a nice one there is Rod's up there.
Steakhouse.
A little bit smaller, but I think for me is that at the end of the day, there's nothing like looking at that lake, having some of their nice Okanagan wine,
Agreed.
and hanging with friends and family. So that's good.
Agreed.
Al, number 2, what are you currently binge watching or a movie recommendation?
Oh, Jesus. You know what? I just sort of binge watched, what is that? The new Lord of the Rings thing on Amazon. So,
Dragon, something dragon.
something like that. So it was Amazon Prime. I put it in there. It's like, that was
Not
what it
the
is.
HBO one, the Amazon one. Okay, all right.
The Amazon one.
And was it good?
You know what? Not bad. Hey, again, I got 3 young kids. It's like I got to put on like the friendly version. The HBO might be a little bit too much for young kids to pop a look at that one.
Right.
So Al, something you've bought for $2,500 or less as of late that's changed your life in a positive way.
A puppy.
Oh no.
Really?
Yeah.
I'll tell you right now.
I got wound down, boys. I got wound down, and so it was. The kids are going. Our lives aren't complete until we get a dog, and so it was after 2 years I relented. We got a family dog, and our household is much happier. It's a cute little dog.
So here's the problem: is it might have cost you less than $2,500 now when you acquired the dog. But I can tell you from experience, because my dog Dexter's 9 now, it's going to cost you a lot more than $2,500 during those puppy years, because they're going to eat every baseboard in that house you have. And that's a big house you have. Every baseboard, Al. Every baseboard.
It sort of comes into it is, I don't know. We'll see. I've always, first time I've ever had a dog. And so we're learning lots as we go. But I can tell you what, after a long day is like, used to come home, crack open a beer. Now it's, you got this dog that wants to go for a walk. So it's part of my thing to maybe shed a pound or two is push that beer off and take the dog for a walk.
Nice. I guess I should get a dog then.
No, Adam says this, and this guy lives at F45 here. He's got the best jawline in the city. Okay.
Yeah.
From the beer. Death row meal, Al. What are you eating on death row? Your last meal?
Oh, Jesus. Death row meal.
These are getting harder every time you're on.
You know what is that, I got to say, if it was the last meal, I'd want a nice steak, right? Like I love the steaks and the Caesar salads and, the nice big baked potatoes and all that kind of stuff. If I'm going, I want to put on like a nice 8 to 10 ounce, nice steak. That's where I'm at.
Who's the most underrated quarterback in the fantasy pool right now?
Oh, Jesus. Underrated quarterback, Jimmy G, who, I'm still a little upset that somebody outbid me on Jimmy G the other day. His first name Josh, last name Joanda.
Josh from our New West office.
Yeah, he popped out. I'm still angry with it there. Thought with the other quarterback going down, I might be able to sneak in that Jimmy G, but no luck on that one.
And last but not least, Al, some advice for somebody who's looking to get into the commercial real estate market as an investor. What would be the advice that you'd give someone who's just starting out?
As interest rates continue to rise, how do you navigate that?
You know what? The two things one main thing is build your team. It's always, and you guys have seen this, man. It takes a team to be successful. You need to incorporate, a trusted person from the real estate side of things, get yourself your realtor that you really enjoy, you trust, and do that. The second thing is like a commercial mortgage broker. You really can't, invest prudently in commercial real estate without understanding the debt solution that comes into it, because nobody buys commercial properties without debt. And if they do, they're a rarity. You always get, in general, superior rates of return with a leveraged solution on that. That's why they have leveraged returns as a key investment metric. So we're just lucky to be in our spot is that, we consider ourselves just a very approachable, commercial mortgage broker. I was just chatting with, one person the other day, and we just chat about once every quarter, and, it's like 15 minutes, 20 minutes. We, strategize, discuss, talk interest rates, do all that kind of stuff. And listen, 15, 20 minutes, of my time, of anybody on our team's time to just, talk about things, meet somebody for a coffee. We'd be honored for that privilege to be able to do that stuff and just be, a key member on the team. And you know what? Sometimes, the decision to buy isn't now. The decision to buy is in 6 months. The decision to buy is in a year or 5 years. I'm doing deals with people that I, haven't talked to for 5-10 years. They just, we had a great time at one point, and then, your paths, diverge, but then you come back again. So it is, from us, those are the two key people, and I think we can help steer people or give them information that they find really beneficial.
Amazing, Al. So how do our listeners get a hold of yourself and everyone over at Impact there when they want to call you with their next commercial property purchase?
You know what? It's just give us a call, our main line, or you can just call me, directly. Our numbers are all on our website. We're not hard to find. And then we would just sort of sit down and figure out what's the best fit. We have a number of guys here. They're all very, very capable. And, that's how we would do it. But, maybe it's just, just reach out. Don't hesitate. The time to do it is, don't delay. The process is a process. It can be lengthy. It can be short. Just reach out, start it today. And, clients will be in a better spot for doing that extra preparation, now versus waiting, next month or even next year.
Well, Al, we really appreciate you taking the time. We know you're busy. And like I said, you're definitely a fan favorite on the podcast. We are Podcast the People, and they were asking for Al from Impact by name. By name.
That's awesome, boys. I appreciate the kind comments on all that stuff. And, as always, love spending my time with you guys. You guys are the very best.
Okay. Well, thanks again, Al. Take care.
Thanks so much, Al.
Take care. You bet, guys. Have a great one.
There you have it, folks. Our interview with Al Haigh, principal, partner, founder, Impact Commercial. I thought it was very informative. I took away a lot today.
You know what? I always learn a lot when we're talking to Alan, and he's helped so many of your clients over the years. Yeah. And we've sent a lot of clients his way as well. And the feedback is always 5 stars.
100%. I can't recall ever having anyone not work with Impact and have a bad experience.
Yeah.
They've always delivered. And my investment strategy has always been is I typically will go write an offer on a property. I will call Al and say, can I get your feedback? And Al will say, Core, can't afford it. Not the right time. Let's wait. 30 days goes by. I remove my subjects.
Right.
I call Al and say, Al, I owe this guy $2 million.
Now you're in panic mode.
And then, I'm not. He is.
Yeah.
There's a long pause where he's probably just swearing into the air at this point.
Right.
And then he always murmurs, send it over. and he's always delivered, right?
So, right. A terrific team over there at Impact Commercial. Always great. Corey, what can people do if they want to talk about the various asset classes right now? I know we're in a transitioning market. We talked a little bit at the beginning of the show about what's going on across the board, but there are pockets of really intense activity right now. Yeah. And then there's some softer markets. What if people just want to pick your brain or talk to somebody on your team? Yeah, they're always welcome to reach out to us. They can send me an email at corey@williamwright.ca. Always happy to talk real estate. They're welcome to call our Vancouver head office at 604-428-5255. Let us know what you're looking for, and we'll put you in touch with the best broker in the province to service your needs. And then they can also visit our website, williamwright.ca, anytime, where you can sign up for the latest and greatest. Hey, you guys got a new site too, eh? We do, yeah. It was good. Yeah, it was an 8-month project, formerly called the Money Pit. Because every time we turned around, there was more money had to get put into it. But it's, I'm not a tech guy, as you can tell by my Apple iPhone 1. Right. There's so much that goes into the back end of building a website to make sure things search properly. And obviously, we've been very fortunate here to grow at the pace that we have and have the number of offices that we have. But we have to sort of set up for future that if there is other provinces or areas that we definitely want to see ourselves open up in, we got to start putting that back in together now. So what we all thought, maybe not what we all thought, what I thought was going to be a 60-day project turned into an 8-month project with a second mortgage on my house. But nevertheless, the website's done. Hey, we're in one of those right now as well with the Vancouver Real Estate Podcast. So we're all blowing money. Anyways.
Can't take it with you.
Yeah, exactly. Well, thanks for your time and thanks for listening, guys. And we'll be back next week with another great episode.
Thanks, guys.
Subscribe today.